On a tranquil afternoon, beneath the shade of a majestic tree, the curious astrologer turned to the parrot and said, "Tell me, dear parrot, what do stars reveal about my destiny?" With a knowing twinkle in his eye, the parrot responded, "O wise one, you seek answers from the stars, but it is you who holds the wisdom. I am just a humble messenger offering guidance." This story left a lasting impression on me. We often rely on a plethora of tools and charts, occasionally letting them dictate our decisions. We must never forget that it is our insight, our understanding of the context that truly steers the ship. These tools are mere signposts, helping us navigate the path, but the captain of the ship is always us. First, it's essential to establish our expectation for the long term. If we review the data for the past 10 years, the large cap index has consistently delivered returns between 13% and 14%. To be prudent and account for uncertainty of the future, let's conservatively expect a long-term average of 12% return. Looking at the monthly performance, recent returns from the Nifty indices for the 3-year and 5-year period, returns exceed the long-term average of 12%, while the 1-year return falls slightly below. When returns of the 2 or more time frames surpass the long-term 12% expectation, exercise caution. When returns of 2 or more fall below, anticipate good future returns. The mid-cap index delivered an impressive 22% annualized return over the past decade. But again, for prudence and margin of safety, if we expect an 18% long-term returns in the mid-cap space, and if you look at the current mid-cap returns, they outperform the long-term average for 1-year and 3-year period, but they fall short for the 5-year. This suggests a need to moderate future return expectations. Conversely, 3-year return of the Nifty 50, which is an impressive 21% annualized, indicates a substantial undervaluation 3 years ago when the investments were made. If we look at August 2020, that is 3 years back, Nifty 50 returns across all 3 time horizons was undervalued and below long-term 12%. In summary, exercise caution when current returns exceed expectations in at least 2 of the 3 time horizons. Consider good future returns when 2 or more time frames show returns below the long-term average. This data is beautifully established here in a related chart. Where investments are made when valuations are high, multi-asset funds would have delivered higher returns than the pure equity Nifty 50. But where investments are made when valuations are low, Nifty 50 has delivered higher than the multi-asset funds. So, in our 3 time horizon investing framework, you could invest in a multi-asset fund when 2 of the 3 time frames show higher than long-term average. And when 2 of the 3 show lower than long-term average, valuations are cheaper, then you could consider investing in the Nifty 50 or an actively managed equity fund. There are exceptions to this, which I will cover at the end. Price to earnings or P ratio of the index is a key indicator of valuation and determines whether or not to invest in equity. The blue line here indicates the PE and the black line is the 3-year return forward from that time. For example, in the year 2000, the PE of Nifty was about 28. For investments made then, returns 3 years later was about minus 10%. In 2009, the PE was a very low 10 and the returns for investments made then, 3 years later, was very high, close to 30%. When PE ratio was more than 22, average 3-year forward return of the Nifty 50 was 8.5%. When the PE was less than 22, the average 3-year forward return was close to 18%. Few exceptions. During the post-COVID recovery, although the markets were trading at an all-time high valuation, equity markets delivered a very good return. India's growth story and the markets don't always go in tandem. India's nominal GDP has been 13.3% and market returns has also been 13%. However, there were 9 years when the economy grew at 12%, but the market gave 0%. Again, for 6 years, GDP grew at 15.7%, but the return from equity was 0%. So, when valuations are expensive, it is prudent to look at multi asset investing. Please consider subscribing to this channel if you liked the video and share it with your friends.